let's go on to, welcome to Directors Loan Accounts and Know Your Blind Spots. And it's only because of the recent changes, really, that it brought this around, this idea of holding this webinar. So firstly, because I had a conversation with Gary, and Gary didn't seem to understand what a director's loan account, which for me is quite shocking, being in the tax world, because it's quite, quite basic for those obviously in the tax world. But it was concerning that a company director didn't understand the full significance. Then he went from that to Marco also suggesting something about directors' loan accounts. And with the increase in the tax, in national insurance and the dividends, and the fact that the changes and the impact on the director's loan account also is not very well known. So I thought it'd be really good to put this webinar together where we have right from the beginning catering for company directors who don't know about director loan accounts, to the significance, the impact, and then going right all the way through the journey of when the director's loan account is set up, what you can put in it, what happens when you have a tax investigation or HMRC asks questions about it, and right to the end where when the company is liquidated, what happens to the director loan accounts then. And in that you will have mentions about bounce back loans, because that is another key current topic at the moment, which we've also put in this webinar. So, and that's where we got the idea from, Know Your Blind Spots. And that's what we want to do. So we want to shed light on this. Welcome to Marco, a very good colleague, friend of mine. He's a licensed insolvency practitioner. Sorry, not liquidator. I've been corrected on that. Of course, you all know myself as a tax investigation expert, and Sean Davin, who's the first time we've had on this webinar, and is a very experienced forensic accountant. He will be kicking off this webinar, starting on, because he's got a lot of knowledge in this area, starting off on what director loan accounts are. So Sean, if you want to start off, and I'll put it on the next slide.
Yes, thank you very much indeed, Jasmine. Very warm welcome to everyone else. I'm spotting some names that I see on the participant list. No doubt we'll engage further later on. Now, we'll kick off, if we may, with directors' relationships with their own companies. And they need to identify these days in real time whether they are owed money by the company, i.e. the director is a company creditor, or whether the director owes money to their own company, i.e. a company debtor. If we can go to the next slide, Jasmine.
I'm trying to, if you will listen to me.
Okay.
Okay, yeah.
All right. Now, just some terminology. Directors' loan accounts and directors' current accounts. People sometimes think, and when I say people, I mean our clients, directors of companies, they think there is a difference between directors' loan accounts and directors' current accounts. Of course, we know there isn't. It's just what people call them. But in a straw poll that I did yesterday, and indeed Jasmine did the same with her contacts, Jasmine discovered that 37% of her contacts did not know what a director's current account was. And I've got to tell you, folks, 67% of the 23 people that I polled did not know what a director's current account was. They thought it was a bank account.
We discussed this, yeah, because the majority of my network is actually accountants and tax agents. So yes, it would be surprising if they didn't know what a director's loan account was. So my voters, when I conducted the polls, is coming from that area of knowledge, whereas your one, I would say, if we had 100% company directors, and that's been commented on as well, commented on in LinkedIn, we would expect it to be a lot higher. So I completely agree with what you're saying.
Yes, and the 5 or 6 of them that knew what a director's current account was all had accounting backgrounds, except for 2 who knew what they were only because HMRC had started inquiries into their directors' overdrawn current accounts. So the message to the majority of the people attending here today, the accountants, the tax advisors, etc., do not make assumptions that our clients know what we mean when we talk about directors' current accounts, and more crucially, directors' current accounts being overdrawn. People relate it to bank accounts and not to the records of all transactions that go through the accounts. So if we go to the next slide, if possible, please. Thank you.
If I may jump in there, at the moment, we've done a straw poll in our guests here today. 88% know what a director's loan is, 13% don't. Let's see if by the end of our webinar, if those are the ones that don't understand. Sorry to interrupt.
That's
really good real-time information, Gary. Thank you very much.
And you know why? Because the majority are like accountants and
of course.
agents, which is, I'd be surprised if we didn't have as high as that. I'd be really surprised.
Yeah. But remember, the message really is to the accountants. Get that message more and more out to your clients, because in this real-time world that we live in, there is no such thing anymore as mopping up at the end of the year. You need to be monitoring these things with your clients' accounts monthly, quarterly, etc. Now, why do we have directors' accounts, and how might we portray that message over to our clients in a way that they get it quite quickly? I've often found if I said sales accounts are to record sales transactions, purchase accounts are to record purchase transactions, expense accounts are to record expense transactions, and guess what? Directors' accounts are to record directors' transactions. Does that make sense? Hopefully that makes sense to all of you. On your go, Jasmine.
Yes.
Okay, what is an overdrawn director's loan account? We've already said it's not a bank account, it's a record of all the transactions between the company and the directors. So we would include in that not just salary, not just dividends, but those as well. But we'd also include money that the director puts into the company, assets at a proper valuation that the director puts into its company, and it is his or her own company, and also what they take out. We seem to have moved off the slide there.
All right. Yeah.
No problem. Can we go back to the last one?
Yeah.
Thank you. The balance on any director's loan account or director's current account represents the money owed to the director if it's in credit, if it's in debit. I don't like to use those terms to non-accountants, but I'm talking mainly to accountants. But to those of you that are not accountants, when I say debit, treat as overdrawn, similar to an overdrawn bank account, but not a bank account. You owe money if something is overdrawn. And the crucial thing is, in the same way that if your bank account was overdrawn, there would be consequences. Similarly, if a director's current account or a director's loan account is overdrawn, there are also consequences to that. So if we can move on, yeah. Thank you very much. And thank you also to your colleague who managed to get this schedule on there. I really appreciate that. Thanks a lot, Jasmine. Now, an example here of a director's current account, which is what accountants look at when they are preparing accounts for the company. You'll see at the top in this example, on the 1st of April 2020, there was £1,000 owing to that director from the company. It's not in red, it's not bracketed, it was owed to him, the director as a creditor. As we move down, the salary for April is processed, and the tax deductions and the net pay that was transferred to him are all appearing on the debit side of the account. So it really is kind of stupid simple. You add what is in the credit to the balance, and you deduct what's in the debit column from the balance. And you'll see, if we just look at line 8 there, box H, there is £1,000 still owing to the director, as there was at the beginning of the year. Let's say in May he's voted a dividend, and we assume all the paperwork for the dividend is correct. That's another thing that I'm sure Marco will be emphasising, and indeed Jasmine will be emphasising later on when they speak. You add the £6,000 dividend, assuming it's been legally voted and there are reserves to voted and it is done in real time. That brings the balance to £7,000. You can see on this, in this example, on the 15th, he had £4,000 drawn out of the bank account, transferred to his personal account, his wife's account, whatever, leaves a balance of £3,000. However, they then decide to splash out. And whatever they do, they spend £15,000. They transfer that to their own personal accounts. This, of course, triggers, and you know about this if you keep track of it, an overdrawn balance in the director's current account of £12,000. It stands out like a sore thumb on this account, in bracketed, in red, and narrated with OD beside it. Now, if you look to your right, you will see the accountants, and you will know this, but we'll go through it anyway. Those of you that aren't accountants, immediately you're triggering a liability, just to get technical here, section 455, but treat it just as corporation tax, of 32.5%. Now that has jumped up in recent years. It was 25%, it's jumped up. So immediately £3,900 should be lodged with HMRC to cover the £12,000 overdraft. Now, you can see as we work our way down the current account, the May transaction, how it affects the overdrawn balance and the respective ACT liability, the section 455 liability with the tax office. We then get to February, and this particular director has introduced £6,500. We spoke about them introducing assets or cash, £6,500, which reduces his indebtedness to his own company to the sum of £5,500. Now, I've also put 10 months payroll transactions into the last month of the year, 25,000, which is 2,500 times 10, 25,000, and I've reduced, I put in debit entries to cover 10 months tax and national insurance transactions on lines 18 and 19, together with 10 months net pay, £20,000. So now the bottom line is he is also overdrawn at the end of March by £5,500. Unwisely, it would seem, he or she draws another 7,000, and we are at £12,500 overdrawn. Now that £12,500, the cumulative effect of that is that there is a corporation tax section 455 liability of £4,063 to be paid over to HMRC.
Okay.
You can, of course, repay a director's current account within 9 months and 1 day of the year end, and we'll talk about that later on. But if you can move to the next slide, please. Thank you very much. Now, where do you spot, for those of you who are not accountants, where is it you see the director's current account balances and whether they're good news or bad news in the formal financial accounts, the year-end accounts, the external accounts, if you want to call it that? Well, if the director's current account is in credit and the company owes the director money, which is good news for the director, this will appear in creditors owing within a year. If the director's current account or loan account is in debit, i.e. overdrawn, the director owes the company money, and that balance will be shown as a debtor and normally narrated as other debtors owing within the year. Somewhere there will have to be a note that says other debtors includes X amount owed by Director J. Smith or whoever, etc. And over the page, thank you again, Jasmine, for pulling this one together. You'll see where those that there is obviously two directors in this company with opposing positions. One who owes his company or her company money, £6,999, and that stands out like a sore thumb there. By the way, these things always bring attention. They're never good news in my experience. I'm sure most accountants in the room would say that as well. The director who is owed money by his or her company appears under other creditors in note 6 there, £6,900 owing. By coincidence, similar debtor and creditor position, but I assume they are different people.
And I can say that all three of us would look at this straight away. Marco would look at this at his end, wouldn't you? And I definitely would look at this as someone ex-HMRC. As a caseworker, it's one of the first things we do. We look at the other debtors and other creditors, and then we will ask for a breakdown to see if there's any directors' loan accounts, and that will be then looked into further. So this is one of the information amongst all three of us that is common. Is a common thing that we would look at.
Yes, so for the account, this will be second nature to the accountants, of course, but to the directors in the room or non-accountants in the room, I hope they're getting an awareness for the importance of how their directors' affairs are conducted and what significance they themselves need to attach to addressing their own directors' affairs with their own company. If the proverbial happens and it hits the fan, these areas, these transactions are going to be looked at. And Jasmine has already given her spiel on that, and Marco will do the same, no doubt. So there we are. All right, on we go. The consequences of an overdrawn director's loan account or current account. As I mentioned when I was talking, when I was going through the schedule, the company must currently pay 32.5% of that to HMRC. It can reclaim that when the loan is repaid. It's called Section 456 or 457 relief, I think, something like that.
Yeah, Section 456.
Okay, I bow to the investigation. Okay, you can reclaim that if it's repaid within 9 months from the day of the year end. Obviously, if the Section 455 liability is paid late, then there will be interest on that, and that won't be reclaimable ever. For the director, there will also be a benefit in kind charge. People who are not accountants will connect that with the old days where they got charged benefit in kind for either medical insurance or for their fuel or for their car usage. It's that kind of non-cash benefit that they will be charged interest on if they are paying less than the official rate, which since April has been 2%. So if they're only charged 0.5% or 1%, they would respectively be charged the tax on the saving that the 1.5% or the 1% has given them. So if it's a small loan, it's not going to be that much, but if it's a substantial loan, there could be a few quid to pay in tax there. Now, again, I know this will be fuel to the fire for Marco and his team, and people who look into companies who've gone insolvent. If there is an overdrawn loan account, the tax issues are, what they are. But what an insolvency practitioner, and I'm sure Marco will take over this point, will do is he or she will be very interested in investigating that to see if it can be increased and whether it can be recovered from the director personally. And there are significant consequences to an overdrawn loan account if the director has financial cash problems, him or herself. Do you want to comment here on this, Marco?
Yeah, I mean, we'll go into a bit more detail, Sean, on the later slides, but ultimately, any money that's borrowed from the company, the appointed practitioner will have a duty to realise the company's assets for the benefit of creditors. As you quite kind of correctly allude to in previous slides, any overdrawn loan account sits as a company asset on the balance sheet, and therefore the appointed practitioner has a statutory duty to pursue that asset for the benefit of creditors. Now, there will be some commercial aspect to whether or not pursuit is worthwhile in the creditor's interest, but certainly more often than not, that proves to be the case. And unfortunately for directors, fortunately for creditors, there are certain powers, significant powers within the insolvency legislation that enables the appointed liquidator administrator to pursue the individual. We'll come on to how that kind of fits in with other transactions that we're able to pursue, such as preferences, for example. There are all sorts of routes and antecedent transactions available to us. But yes, ultimately, I think that the sort of scary final sentence on this slide is that, worst case scenario can result in things like charging orders being taken against personal properties or even bankruptcy petitions being served. So absolutely spot on, Sean, serious stuff to be playing with.
Yeah, and of course that old favourite, transactions at an undervalue and such like. Okay, thanks,
Okay.
Marco. Jasmine, unless you have anything to say, we'll move on.
I think Marco, the reason why I've asked, we've got Marco on board today is because a lot of the accountants and company directors are unaware of the impact that having an overdrawn director's loan account can have when the company goes insolvent. So I think he will go into it in more detail, and it's particularly, I think, relevant and important. And he's the best person to go in more detail in that, and we will do later on.
Yes.
So it. Because I wanted it to have this webinar to have a span over the impact of directors' loan accounts and taking loans out from the company. So I've added in about the loan benefit in kind as well. So if you've got a loan of more than £10,000 and you're a shareholder and you owe your company more, so there's a de minimis amount in regards to benefit in kind. So you would have to treat that loan, if it's more than £10,000, as a benefit in kind. You would have to deduct Class 1 national insurance. And again, it shows here where the 1.25% increase has an impact, and that will be relevant from April 2022 onwards. So it has an indirect impact here in regards to the benefit in kind. You have to report the loan on your personal self-assessment. And you may have to pay tax as well, especially if you paid the interest below the official rate. So you would have to calculate the difference in the difference and then the tax on that small amount. But saying that, sometimes it is a lot more cost effective to do it this way, rather than take an official loan out from somewhere else, for example, a bank. But this is the procedure in declaring a benefit in kind in regards to amounts of more than £10,000, and there's a de minimis on loans. So anything below £10,000 is, there wouldn't be income tax on that, but anything above that as a benefit in kind, there would be. And so I think that's quite important to understand, that in regards to tax consequences, in regards to benefit in kind, the de minimis amount will be £10,000. I put my teeth back in, sorry. Right, we had an interesting discussion about this, and I've put this in there just to cause a bit of controversy, really. Can a DLA actually be written off? And so both of you, Sean and Mark, if you want to jump in, please, you're welcome to do so. So I looked into this option. I haven't had this happen on any of my cases as such, and it's definitely not one I would recommend. But it is, as a process, it does exist, but it can be more costly as a result. So, I mean, if a DLA account, a director's loan account, is going to be written off and it's overdrawn, it has to be formally waived. So you can't do it like off the cuff kind of thing. Oh, I'm going to just write it off and not put anything in as officially. If there's no available profits to distribute, it's called a deemed dividend. You'd still have to pay national insurance on the amount that's overdrawn. So regardless of the fact that it's there's no profit to distribute, it's still a deemed dividend, and so the 1.25% again would have an impact here from 2022 onwards. Again, the same procedure, you'd have to put it in self-assessment in the additional information page, and for income tax purposes, it'd be treated as a dividend, but no corporation tax relief would be given as a write-off. So there wouldn't be any relief there, as for example you would with the bad debt. Well, the bad debt it depends again. That has to be follow a procedure after 6 years as well. But in this case, there wouldn't be any, which can end up being a bit more expensive, perhaps in that respect. But if we're looking at an insolvent position, someone like Marco will definitely look at that transaction if the DLA has been written off, and is it really been
Jasmine, just to sort of throw a few comments from the insolvency practitioner's viewpoint, you won't be surprised to hear I don't get comfortable at all with the potential of a director's loan account being written off. One of the first things that I would do upon any initial inquiry would be to review historic accounts, and I quite like how Sean sort of pointed out where you would find an overdrawn loan account in a set of accounts, because one of the first things that I jump towards when I look at a new inquiry is what's the other debtor's position in the accounts, and actually is what the director's telling me about the financial position of the company actually correct. If I went back 3 years, for example, and other debtors were showing at £100,000 due to the company, and all of a sudden within the last set of financial accounts, that amount had disappeared, or there was no kind of tie up between point A and B, there are lots of other powers within the insolvency legislation that still allow us to pursue those amounts, regardless of the fact that the director claims to have potentially written off that loan account. You mentioned before insufficient reserves, so something known to the insolvency world as illegal dividends, essentially just dividends that have been either declared and taken, or in this case, deemed to be a dividend in the event the company's got creditors, i.e. insufficient reserves, and is unable to meet those liabilities. Those can be pursued as illegal dividends regardless of the fact as to whether they started off as a loan account or were an actual dividend. The moral of the story is the company's not got sufficient money to pay its creditors and pay its liabilities. Of course, the legislation is not going to allow the directors' members just to draw money out and run off into the sunset. It doesn't happen that way, unfortunately, for obvious reasons. Sean also touched upon earlier, Sean, just to go back on the transaction and undervalue point, that is essentially a section within the Act that allows the appointed practitioner to pursue anything that may have been given as a gift or for significantly less than market value to a director or connected party. We've got various powers available to us, and ultimately we touched upon this when we spoke a few days ago. If it doesn't quite feel right in the director member's gut that you shouldn't be taking that money in the event that you can't pay all of your liabilities, naturally there's generally going to be a transaction that allows the appointed practitioner to pursue you to overturn that position and ultimately get the money back in for the benefit of the company creditors.
So even if it was formally waived, and you can see class 1 national insurance has been paid, from the director's perspective, it's been recognised as a deemed dividend. And there's no corporation tax relief. I mean, all of this process has been followed. You would still pursue that?
Well, look, if it's a deemed dividend, then essentially it sits as a dividend. So if, for example, I'm receiving claims from creditors that are 6-12 months old, and I review the company's financial position 6 months ago when that deemed dividend was deemed to have taken place, if in the event that the money that's been taken from the company has prevented it from being able to pay its liabilities, and looking at age creditors, 3, 6, 9, 12 months, for example, then technically we can make an argument that the company had insufficient reserves at the time to have made that deemed dividend and pursue it as an illegal dividend, Jasmine.
Okay.
And
that's why.
Payment of that.
Yeah, well, look, an illegal dividend similar to an overdrawn director's loan account or any other sort of misfeasance type transaction that has been taken to the detriment of creditors, We will always consider suitable negotiation settlement, but ultimately, these claims can be pursued through the courts and enforced in the same way that you would anticipate to be the case, Sean.
Can I just clarify here, and maybe Jasmine might be the person for this, but has the position on formally waived dividends been clarified in recent case law, where deemed dividend was brought to the fore? Do you recall something?
I think definitely the courts the tribunal courts have a position on illegal dividends, definitely. But I'm not sure, not really on formally waived. So that I would have to look into further. But it's an interesting point because there's a process here that can be followed, but it shows that at the end of the day, it's the intention behind it, whether it's genuine or not, and the circumstances around it. So if it's just used as a way of, taking money out at will and thinking there's not going to be repercussions, then it's not going to ring true, is it? And
my own take on that is that over the last few years, where directors' current accounts were, many years ago, were really, very, very poorly treated from a regulation point of view. I think the two ways where any deficiency in a director's current account would be amended would be by, taking salaries out, voted, of course, near the time of liquidator's been appointed, but before that. And of course, there is legislation now under what I call the regulations, Regulation 72 and Regulation 86, to transfer the personal liability for the PAYE on that clearing up salary transaction directly to the director concerned. The employer's national insurance isn't, but the employee's national insurance and the tax, gets transferred, and that's for real. They really do that. And of course, the deemed dividend now bolsters that. And really, the message to all the accountants that are listening, and the message to the directors who are non-accountants, really, I emphasize for the second time, you need to make sure your director's current account, you need to know what it is, you need to know what it's made up of, and you need to make pretty sure, unless you've got a very good excuse, that it's in credit at all times. That's really the message, really, isn't it?
Definitely, I agree with you 100% on that in that respect. But I do know on where it is transferred, there has to be indication of deliberate behaviour. So to show that, for example, I've had two cases. One where the director was taking money out, not paying the wages as they should have been, but you can see evidence in their lifestyle, in their property purchases, the buying cars and so on, whether it's of a deliberate behaviour or not. And so they do look at all of that, the whole circumstances and behaviours of the directors on there before thinking of transferring the liability personally in the director's name. So yes, definitely. Okay, which leads us nicely.
Tony Magratelli there has come up with a good point. Small company directors gamble on future profits when they simply withdraw funds and assume it will be covered by dividend. Says it all, Tony. Good point. And I would also say it doesn't apply to small company directors alone. We won't mention any names now, but there are some big companies out there who have attracted attention along those lines.
And I think that this is definitely the case with company directors who have struggled. You said no mention names. Who have struggled throughout the pandemic, have had no assistance but the bounce back loans, and have had to live off the bounce back loans as a result, because they've not just had no access to, for example, universal credit, or the sales have gone down, trade is not performing well, and they've not had assistance with any of the COVID-19 grants either. So there are some desperate situations which has taken place.
Yes.
But we will definitely discuss that. So moving on to, we've seen how directors' loan accounts are formulated, what it actually entails, what does it mean, how would you recognize it in the company accounts, and the fact that to be overdrawn where you owe money to your company is it's not really a good place to be. There will be tax consequences as a result, and the reason why all that legislation was put in, where the Section 455 tax is put in, is in order for directors not to take advantage of that situation and use the companies like their own bank account, really take money in and out whenever they want without any consequences. So you have a temporary tax, it's meant to be temporary tax, Section 455, which you pay 32.5% on the tax when you take it out, and then when you repay the amount, you get that rebate. In tax investigations, and most of the time, what we have is a situation where the profits have been understated for whatever reason. Can be understated. Sales is just one example, but for whatever reason, the profits have been understated. It's been established through the accounts, and what HMRC would ask is, where has the money gone? So you've taken money out from the sales, where has it actually gone? And if it can't be justified that it's being spent or incurred on purchases or expenses, and there's no audit trail, HMRC then will say, well, then we will assume the director has pocketed the money. They've taken it for their own use, for their own living expenses, because you have not been able to demonstrate that the money has gone elsewhere. Most of the time, you find in HMRC approach, sometimes they just do it as a default position. So that's when you would have to challenge that if there's evidence to demonstrate otherwise. The difficulty here, I find, is when you have a compliance checks or tax investigation, it's done in a particular period, and then you can have HMRC going back, applying the results of one compliance check to previous years. And then what you have is a situation where the accounts are virtually reconstructed several years after the fact. And so in hindsight, you will have an overdrawn director's loan account, and then you'll have a considerable Section 455 position. So as an example, sorry to those, I'm old school, so Section 419 is theirs, which is what used to be named as, but you'll have something like this, an example where there's a declared turnover and it's these amounts, and then you may have, this was starting out 15% uplift because they were able to demonstrate that there was sales missing. And so they then use a kind of broad brush general approach, uplift by 15%, and so there's an adjustment on the top figure on sales. So you've got these adjustments going back all the way, and then you've got corporation tax 20% on the additional sales adjustment, and then you've got a Section 45 position, and you know, it'll be considerably more than the corporation tax. So it's almost like a double whammy. Actually, as well as the corporation tax, you've got the Section 455 position, which would now be, because before 2016 it's 25%, but after 2016 it got uplifted, as I'm sure a lot of you know, to 32.5%. Hi, Carlos. And so the issue is that when you've got a position of where there's an understated profits, the corporation tax can actually have a huge impact in comparison to VAT, because you've got the corporation tax itself of 19 or 20%, and then you've got the Section 455 position, which is considerably more at 32.5%. And at that time, it's quite difficult for a director to be able to repay that amount back. So then you will have a considerable Section 455 liability unless the director has the funds to actually pay the money back.
Jasmine, is it worth just sort of jumping in to ask the question as well? Because presumably in a retrospective kind of calculation like the one that you've given to us here, presumably if there's a backdating of effectively additional liability, there'll be interest and penalties applied in addition to that position. And you can start to see from the total figures at the bottom, if you take those numbers as a cumulative, add interest and penalties, that's when people like me are getting the phone calls with regards to the six-figure claims that these directors of the companies can no longer afford to pay back and have no option other than to liquidate.
Because they become insolvent, because the figures become so huge. If you think about it, the corporation, you got the sales figure, you got the corporation tax, then you got the section 455 position, then you got the liability, which is the penalty, which is a percentage of the tax assessment. And so everything has a knock-on effect. Then you've got the VAT side of things, and you've got the penalty on that side of things. And sometimes you've got pay as you earn side, and then you've got a situation where there could be possible personal liability notices. So I've had cases where they've come to me and there was only a VAT assessment, and then I will say, well, there's going to be more. It doesn't stop at the VAT position, because at the end of the day, you can only have one sales figure. You can't have multiple different sales figures.
It's probably worth taking into context as well, Jasmine. Directors out there may have been thinking, Crown debt effectively sits with the rest of the unsecured creditors, which was the case prior to recently. But, HMRC are now a preferential creditor. Essentially, they sit above all other creditors in the event of a company going into an insolvent position. And therefore, the prospect of HMRC regaining at least some of what's owed to them through a company insolvency from the company's assets once an appointed liquidator is in office, becomes far greater than what it would have been a couple of years ago. So the revenue are incentivized to pursue.
We have a situation where, the client has, or the taxpayer has been advised, okay, the bill, it's just your company cannot afford to repay this. But and then it comes to directly to someone like you, Marco, without any challenge at all of the figures as such. And that's where you need someone to come in and challenge the figures, because it has a cumulative effect. So because the penalties is a percentage of something, normally like the sales addition you saw, you can see here it's 15%. So the 15% has an effect, so if you deal with the 15%, see how they reach those figures, and minimize the years, then it has another consequential effect as well. And then if you reduce the tax assessment, you reduce the penalty, and overall, so it's not as large figures that is first hits you, because HMRC has a habit of just doing very broad generalized figures. And I know when I speak to just any person in my acquaintance, just a lay person who doesn't understand about this, and I'll say, oh, HMRC's come in, they've looked at the figures for one day, they've done an unannounced visit, and based on that 1 day or 2 days or 1 week, they've now assessed the company for the previous 6 years, which sounds quite amazing to them when you say it like that. But indeed, cases have gone to tribunal. But the main thing is you have to challenge it. If you don't challenge it, then HMRC will just carry on with the figures they have. So that's the key takeaway. When you have a director's overdrawn director's loan account as a result of a tax investigation, you need to be able to challenge the figures at the end of the day before it even gets to liquidation.
I know, Jasmine, we're talking about overdrawn director's current account here in section 455 and the double whammy you've set out so clearly there, and how it rolls back over 6 years. By the way, you've got 8 years there.
This one is 8 years. Yeah, this is a different case.
Yeah. But the other, there's a bit of a triple whammy. I don't know if you said it or not, and forgive me if I missed it, but looking at those turnover items there, approximately 1.9 million over the 8 years. 15% uplift, roughly £300,000 in sales adrift, on which there is output VAT deemed of a sixth plus penalties, probably another 50 to 75 grand in VAT money, payable to the Treasury if it wasn't challenged. So it's more than just the corporation tax. And all this comes about because people sought, for whatever reason, to avoid a minimal-ish type of tax at the time. It just is never worth it. I mean, we've all
moral of the story: don't underdeclare turnover, folks. And interestingly, in contrast to that, a lot of recently overdeclared turnover in regards to bounce back loan applications, which will come on to a separate cover.
Oh yes, that'll be interesting, won't it?
Not worth the risk.
You can start writing your book now.
It's just good to show that Sean has started off saying that having an overdrawn director's loan account is not a good thing. But then you get a situation, we have an overdrawn director's loan account in hindsight as a result of a tax investigation that's taken place, which is, very difficult to combat in hindsight. But this is definitely a big reason, because of the Section 455 position, why it needs to be challenged. But this is the impact it can have in a tax investigation. So I was saying earlier about the Section 456 repayment. I wanted to just put across that this is meant to be a temporary tax, but it depends on whether you can pay it back. So I've given an example of where Director A is working full-time. He's a participator and a working director, in that he's a shareholder. Basically, he's a shareholder of the company. His loan account is overdrawn by £20,000. And this is where the accounting period is it's important to understand your accounting period, because at the end of the accounting period, which is here, 31st of March 2012, you got 9 months and 1 day to make the repayment. So here we've got, £20,000 is due on 1st of January 2013, but on 1st of January 2013, you've got £3,000 being paid back. So you'll get relief on that in time, because it's been done within 9 months and 1 day. But he's paid the rest of it on 1st of January 2014. So that will go into the following accounting period. So it's not a case of you've taken the money out, you put it back, and you get the Section 456 relief or repayment straight away. That doesn't happen straight away. That happens when, depending on the accounting periods, the 9 months, 1 day following the accounting period, which is basically when you file your tax return, your company on the company tax return on company house. So you've got them 9 months and 1 day, and that at the same time you would be able to know where you are financially in terms of the company and whether repayment is due. And there's a box there that would say where you can claim back the Section 455 tax on this. So I thought we just put that in to demonstrate that it's a temporary tax, that if you repay it back, and when you would get the repayment of the Section 55 tax. Okay. Sorry, Sean, did you want to?
No, you finish here. Sorry.
Okay. So I just wanted to say about the increase in dividend tax, which is going to apply from April 2022. So we've got 8.75% for the basic rate taxpayers, 33.75% for higher rate taxpayers, and 39.35% for additional tax rate taxpayers. The £2,000 dividend allowance will remain, so that's good. That's good in what we have at the moment. The Section 45 tax is also tied in. So this was something that wasn't really explained by the government, that because the Section 455 tax is tied in, the dividend tax has gone from 32.5% to 33.75%. As a result. So it's had a knock-on effect, and you've seen in the previous slides that the increase in national insurance also has a knock-on effect on the benefit in kind position as well. So that is the impact that we can see all around on that is relevant to the director's loan account. Okay, leading on nicely to what we were discussing about the bounce back loans, I'll hand it over to Marco.
Thanks, Jasmine. Just a quick word of warning, my internet seems to be playing up just at the point at which my slides are due to come on, so hopefully you guys can all see and hear me in real speed. Just give me a wave, Jasmine, if you've got any issues, but thanks for the introduction. And really interesting to hear yours and Sean's earlier slides. So look, I'll just come on to what is currently a significant anticipated issue insofar as the bounce back loan subject that we've all previously touched upon. Just bounce back loan in numbers, just over 2 million applications received, 1.5 million of which were approved. That equates to some 45.6 pounds worth of funds out the door. And ultimately, Jez, can you still hear me?
I can just about hear you, but don't worry, I'll fill in the gaps. We can make it into a game between us.
He's very resourceful, guys.
And he's gone. What he was saying about that the value of approved facilities is about 45.6 billion. And then there's some sectors inside 7.7 billion to wholesalers, retailers. So they've actually broken it down to each sector, 7.1 billion to construction industry and 4.5 billion to professional, scientific and technical activities. So you can see where the majority of the bounce back loans have been granted. I can see some future risk assessment going on in the HMRC sector, that is for sure. And the default rate you can see is a whopping 50%, which is a huge amount. And that is the result he's seeing at his side from his impact, where because of the bounce back loans or whatever, and then they try to close the company as a result. So the headline issues on this is, and I've seen this in our LinkedIn responses as well, that what happens in a situation where the CIS grants were not enough to live on, he was not employed, but the loan is guaranteed by the government. So they think, okay, I've got no personal liability or risk in this event, and I've got no longer have the funds, so I can't be pursued for them. And but did you actually know that one of the big four banks has already started seeking repayment of the bounce back loan in full, where the borrower is under suspicion of having overinflated turnover on the application? And I'm quite sure many of us have seen this or heard about it, where the dormant companies have had bounce back loans applied in their names, or turnover has been inflated, and to which I'm sure HMRC will also be very interested in that. But we have a situation where companies have Marco's back, Gary.
Yes, so just going to say,
bring him back up. Yeah, where we have bounce back loans being granted, but the companies become insolvent as a result. So I'm not sure when Marco's going to be able to come back in, Gary, because he says he's on.
He says he's on. All he has to do is speak, and he will come back on.
But he's not coming up.
All right.
Do you need to bring him up as a panelist?
Let me work that. You carry on talking. You're doing a great job.
He said, "Can you let me in?"
All right.
Knock, knock.
All right. You carry on talking, and we'll do the technical stuff behind.
Yeah. Okay, so what's the view of the Insolvency Service on directors using BBLS loan funding on a reasonable basis to cover their living costs? And they would look at it on a case-by-case basis, whether genuinely the director had no other source of income at all, and they had to draw the bounce back loans as funds for reasonable living expenses. What they would kind of frown upon is where, you know, you can see a vast amount of money, £50,000 or so coming in. It comes into the bank account, business banking, and then it's withdrawn on the same day, and then it's spent all in one day, or it's spent on a, you know, purchase of a house or purchase of a car. That if they see evidence of that, of what's happened to actually the funding, they would definitely look down on, because it's not genuine reasonable living expenses. And so they would have a duty, the banks would have a duty to pursue that. So it's not a case of, okay, we've taken the bounce back loan out, and Marco's come back in, the bounce back loan out, and that's it. Our company is not bringing in any money, so we're going to take it out and make it insolvent. It's not easy as that, and I'm quite sure there will be a long risk assessment as a list somewhere with the names on them, where they will eventually be looked into. Marco, I've taken over your job.
Jasmine, you're a star. Thank you. How did you find bluffing your way through insolvency for 5 minutes?
I was an expert for 5 minutes.
You did pretty well.
Well done.
Yeah.
Well done.
I'm used to that from
very well.
HMRC.
I apologise for my poor internet connection. I am now via hotspot, so hopefully no issue. Look, would you like me to run over those slides for 5 minutes just quickly again?
I've gone back to, if you would explain this slide a bit more, that would be good to know.
Look, interestingly, the hot topic at the moment is all about bounce back loans, as we all know. Just to put some context around the figures, 2 million applications, 1.5 million of those applications approved, rightly or wrongly. I'm sure that will fall out, you know, subsequently. From those applications that were approved, £45 billion of taxpayers' money effectively out the door. Default rates estimated anywhere between 20 and 80%, depending on what day of the week it is and who you're listening to. Let's take, for example, an average default rate of 50%. That's some 750,000 companies defaulting on their bounce back loans, potentially anywhere upwards of £22 billion in default. Many of those default situations, as Sean and Jasmine have quite rightly kind of alluded to historically on previous slides, will have some element of overdrawn director's loan account attached to them. Now, if you listen to what I am seeing, 90% of those companies defaulting on bounce back loans probably would have drawn out all of the monies within the space of a week of having received them from the relevant bank on a personal basis, and therefore owe that money back to the company. But that just puts into context by way of numbers, I think the problem or the issues that this country is potentially faced with off the back of the pandemic lending. And obviously, you know, importantly for those directors and their advisors listening today, we think there's going to be a big fallout in terms of clients coming to the door of the insolvency practitioner where this set of circumstances may have previously sort of played out. Thanks, Jez. On to the next one, if that's okay.
Oh, I went through this. This is okay. But a bit more about the big four who's pursuing the bounce back loans.
Yeah, look, we won't mention any names. I think it's been widely publicised, but you know, there's a lot of scrutiny around those directors that have now clearly taken bounce back loans historically. And I think one of the big four banks has actually taken the step to where the borough is under suspicion of potentially having overinflated turnover to get more bounce back loan from the lender. They're actually recalling these loans in full. We're also seeing newspaper reports of police turning up to people's doorsteps in regards to criminally pursuing these bounce back loans that have been wrongfully misused. A lot of misconceptions around the loans, and Jez, you touched on this earlier. The fact that you didn't have sufficient grants or couldn't otherwise furlough yourself, didn't have any money to live on, is not necessarily justification for the fact that you've got the loan and spent it on personal use. We will come on a subsequent slide, our trade body's view of this, and interestingly the insolvency service have taken what appears to be a sensible view. So if in the event that the loan's been taken and withdrawals of that loan through the company's bank account to personal accounts kind of follow the ordinary course of business, that's seemingly justifiable. Where, for example, you've taken a bounce back loan and within the space of a few days, weeks, you know, subsequently drawn down on the loan in its full, and that money never comes back into the company's bank account, that's where a more pessimistic view is going to be taken of director conduct. And that's where it's going to be a lot harder for directors to be arguing the case that wasn't intentionally misused or, not misfeasance. It shouldn't be pursued by a subsequently appointed insolvency practitioner. So lots of considerations, but ultimately I go back to the point I made earlier. If it feels right or it felt right at the time, then there's probably suitable justification. If what you're doing or didn't feel right at the time, then you've probably got cause to be concerned.
I think a lot of questions that are coming in is, for example, if someone has applied for the bounce back loan and then intentionally closed the company down as a result and withdrawn the funds. And the questions that are being asked is, will there be any repercussions? So if they don't go through an informal insolvency process, what happens to them?
Yeah, it's a really good question. This is the benefit of retrospective legislation. So I think at the time at which the bounce back loans were available, directors with bad intentions thought they'd be getting away with striking off the company without necessarily that getting picked up. The government had a look at what was going on, and through the coronavirus ratings legislation, retrospectively said they've got the power to effectively restore a company to Companies House Register for the purpose of investigation and pursuit. So, if a bad intention director thought they'd get away with striking a company off, that did subsequently change through amendments, through legislation. And ultimately what it's done is bring a lot of these bad intention directors to the doorstep of the insolvency practitioner, who know that the company hasn't got the ability to repay the loan, probably on the basis they've already taken the money out personally and spent it elsewhere. And we go back to holidays, sales of cars going up, extensions on back of houses, payments against mortgages. So I think, Jasmine, simply getting the money and getting rid of the company, no longer an option, thankfully, for the taxpayer.
Okay.
Director's loan account, I know you would have ran through this, so I'll very quickly just flip over, but they are very easy to spot. Sean's done a piece on an earlier slide in regards to where they normally sit within the company's account. If for any reason, accountant, director, for some reason hasn't shown this through the account, one of the most simple things and common things that the appointed insolvency practitioner will do is that we have the power to write to the company's previous bankers and obtain bank statements for as far back as we need to go. Very easy for us to see through companies' bank statements, large transactions, amounts going out from the company's account to, account numbers that will regularly kind of pop up. So even in the event of a director's loan account being missing from management information or from company accounts, the bank statement review will ultimately enable us to sort of finger when and where money's gone to, certainly in the absence of it having gone to company's creditors, for example.
I've definitely seen questions coming up about that. So not just from the insolvency practitioner, but also from the insolvency services as well, where they will query balances or money that's been taken out the company accounts. For what reason has it been taken out of the account? So these are the questions that will have to be answered. And if it's going down a wind-up route where the company's wound up as a result of a petition from a creditor, then the official receivership will eventually ask exactly the same questions.
Yeah, as well. It's important to note as well, because directors have been living off the benefit, the luxury of winding up petitions, being effectively subject to a moratorium over the last 18 months, well, with effect from the 1st of October this year, so literally within the last week. The moratorium over winding up petitions has been lifted for any liabilities over £10,000. So, we can't rest on our laurels, directors who may have sort of been hoping that creditors wouldn't ever be able to come knocking again. That is something that is actively a risk with effect from last week. And ultimately, having spoken to HMRC relatively recently, as many as 30,000 company winding up petitions relating to HMRC debt alone in the pipeline. HMRC's biggest challenge will be one of resource as to whether or not they file a winding up petition against that company, and will it likely return to HMRC as a creditor in the subsequent insolvency.
So actually, it's quite interesting to see that because I've been asked this question about bounce back loan. What is the tax consequences? And I've said it's at the end of the day, it's a loan, and so in that respect, there isn't any tax consequence in that respect because it's something that would go on the balance sheet. But actually, if you've withdrawn money out as a result and it's overdrawn, then yes, there will be tax consequences as that. And if you close the company as well and HMRC is the main creditor, then that will also be looked into as well, because if you've taken, if the company director's taken funds out and a considerable amount is owed to HMRC, then that is something else they would look at automatically.
Yeah. Jasmine, we've got a bit of a perfect storm, haven't we, with the amendments to IR35 legislation, personal service companies. 90% of personal service companies that are referred to me, there'll often be one creditor. It's going to be HMRC, and the only asset in the company will be an overdrawn loan account, typically for the same amount due to the revenue, believe it or not. It's so commonplace that we see this type of scenario, and ultimately the end result is one that we've been explaining throughout this webinar. Directors are going to be pursued to repay that liability. There'll be added complications for directors as part of the conduct investigation that the appointed practitioner has to go through, because in the event that HMRC are the only creditor, there's also investigation around something that we call trading using Crown funds. That is reported as adverse conduct. If you're paying your other suppliers and everybody else with a view to continuation of trade, and you've not been paying HMRC, that's something else that has a very negative view taken upon it for reporting and potential disqualification remit, certainly.
So if the director's loan account is in credit and you've taken bounce back loan out, but it's in credit, then it's less likely to be looked at when you're winding down. When there's a wind up petition, the key thing is if there's an overdrawn director's loan account or money's being taken out and not accounted for from the company, then that's where's the risk. That's where the risk lies.
Jasmine, you have to ask yourself, why is this company in the situation that it's in? Why is there not available funds to meet its liabilities? If the answer to that question quite glaringly is because the director's taken all of the funds out for their own personal use, then understandably the risk to the director upon the business failure is greater, because ultimately, in 9 cases out of 10, the finger could be pointed at the director for being the ultimate reason for it being in the position that it's in.
So there is going to be accountability from the creditors, basically. So it's not a free for all. It's not, I'm going to close it down. It's going to be a consequence as a result of just going down that procedure and accounting to your creditors.
I think the best advice that I can give to directors that have taken a bounce back loan, withdrawn those sums for their own personal benefit and maybe thinking about winding their companies up, is if there's any way that you can afford to repay those monies back to the company. So, the government have said will extend repayment for the bounce back loan to a period of up to 6 years on low interest rates. If the company is not in a position to be able to afford to repay the bounce back loan over that 6-year period, question has to be asked, why is this company trading? Clearly, it's either a zombie business that probably should have fallen over years ago, or it's a company that's purely been kept open for the purpose of using that bounce back loan for personal benefit. Directors beware. This is, I think, is going to be over the next 12, 18, 24 months and beyond, not only questions asked of the government on the banks as to why some of these applications were so freeingly accepted, but clearly where the finger can be pointed at directors for having had improper intention, there's going to be huge consequence.
Okay, which leads us to, I don't have a DLA, do I? I don't have a director's loan account.
Yeah, I just want to finish on this because I through our position as insolvency practitioners, most of my referrals come from intermediaries, typically accountants. Often an accountant will look to retrospectively at year end convert a director's loan account to a dividend. Okay, so for some reason on a monthly basis, directors are allowed to draw loans effectively, and then we'll tally it up at year end. It will be effectively through the accounts be declared as a dividend, and we'll convert it that way. That's all great and well where the company doesn't experience any financial difficulty, isn't it? But if you think about the kind of things that can unexpectedly cause a company insolvency, so bad debt, for example, one of your customers does not pay, unexpected loss of trade. Well, pandemic is a great example of how nobody expected overnight your business to be interrupted, but significantly was. Increase in costs. If you look at the energy sector at the moment, I'm speaking to a £50 million turnover provider of energy services last week alone, whose 4 days worth of energy increases cost them £3.8 million overnight unexpectedly. Unexpected supply chain issues. There are so many unforeseen events that can lead to a company going from a solvent position to an insolvent position, ultimately almost overnight in some cases. The point was raised by Tony on chat earlier. Why would you risk the company's future profit, to give yourself comfort as to not falling into a risky position? I think the point here very much is similar. Accountants, directors, beware. If you are planning on drawing director's loan on a regular basis and subsequently tying up at the end of the year, if something happens in that 12 months that means you fall into an insolvent position, you're potentially, for the sake of a little bit of a tax saving per se, or for it being an easier way of accounting, you're putting yourself in a position of risk that you shouldn't probably have to get into.
And that's why you need to have up-to-date current information on your financial position, so you can take those key decisions. And it's something
we see
that
lots of, as you say, we see lots of accountants who are now advisors, don't we, Jasmine, on LinkedIn on a regular basis, which is great, because ultimately the role of accountant has gone from preparing year-end accounts at the end of 12 months to being a more regular point of call. In today's modern day and age, where that's the case, let's make sure directors are understanding the implications of a director's loan account, and let's make sure that regular management information, we've got all of this fantastic cloud software, Xero and Sage and other certain software available. Let's make sure that we're using the technology to ensure that everybody's protected as they possibly can be.
Exactly. In this day and age, it doesn't make sense that where your company position is like 9 months after the accounting period. It's just not feasible anymore. You need to have on point information. You need to know, like today, what is my net profit today? What is my net profit been in the last several months or accounting period, to understand to make those key decisions you need in order to improve your company's standard or standing or do better. So it doesn't make sense not to have that information, and that's why knowing exactly where you are with your director's loan account, again using the same key up-to-date current information is also important, so you're not overdrawn. Carlos brought an interesting point up earlier on, in that when you're a sole trader and you incorporate your company, because you used to, whatever is left over, that's your drawings, so that will be the money you're taking out. But it's different. There's a different attitude approach when you have your company, because then that's when the director's loan account is created. And if you go into negative, overdrawn, and then that's when you can have these compounding position and tax consequences as a result of that. You're right. You're absolutely right. Accountants and clients should be having these conversations and ensuring that all eventualities are planned for.
There is one other thing, Jasmine, that you need to ensure as well. A good internet connection, which I've clearly failed to have today, isn't there?
Yeah, but you got us, so we carried you, don't worry.
Well done, thank you very much. It's brilliant.
In this day and age, as well as up-to-date current software, you need the internet to carry it too, an excellent internet connection.
Yeah. Can I also just intervene here and just say something? All of the points that you eloquently made there, Marco and Jasmine, about more regular management information, proving that you've got net assets in your company, that any dividends are done properly, with resolutions and the dividend vouchers to the respective people, etc. It's all very well having Xero, QuickBooks, or whatever, perfectly valid smaller accounting packages as well that do the same thing. What you have to remember to do, is to be able to prove at that time that situation existed, not just print out a report later and then hope that's okay. What I would suggest is people comprise or their accountants prepare a bundle of information monthly, perhaps, sometimes quarterly, but monthly would be better. You know, in the PDF world that we all live in, this isn't so difficult, but then to email it to themselves. So the email kind of date stamps or time stamps that information every month. You know, it provides evidence of credibility that it was true at that time, subject to people checking the data. I don't know how you feel about that, Marco, being an IP.
Yeah, look, absolutely agree. Retrospective review, documentation, you know, we work with the benefit of hindsight, and, you know, often it's quite clear for us to go through documentation. You can see, you can certainly make an argument if something's not contained within the books and records in the first place and it subsequently, you know, mysteriously arrives via email, board meeting minutes supporting dividends, that type of thing. I would completely agree with you. You know, retrospectively, things being done is not the best bet. You know, full set of records. You know, even to something as simple, which has been highlighted in recent case law in our world, actually, in terms of a director's duty to keep proper accounting books and records. You know, something that seems quite obvious, but often you would be surprised at the amount of directors that fail to deliver up books and records or suitable books and records. And there's a lot of finger wagging that goes on between directors and professional advisors in terms of reasons why we don't have what we should have. I think the simple answer from an insolvency practitioner's viewpoint is to make sure that you have got everything that would be expected of you in the context of being a director of a limited company.
With the interest of time, I'm just gonna say that we've put a feedback form. We can only improve these webinars if you get involved with the feedback. We will read every single one, I promise. And we're coming into networking time. This is so brilliant, and I love the debate. I love it. It's up to you if we want to continue or we want to go into networking. Jasmina.
Let's go into networking. I've just accidentally copied instead of the feedback sheet all my tribunal stuff. So I do apologise, but it's all right. It's in the public domain, so it's not bad. But yeah, please ignore and delete.
If you unshare your screen.
Yeah.
Now what I'm going to do, I'm going to stop recording.
Yeah.
So that's really important that everyone knows that this is a safe space. Nobody
recording stopped.
Right, so you just heard it stop recording, and then I'm going to stop recording on Facebook.